Crude oil full-cycle costs are one of the critical pieces of information used by oil companies, among others, for corporate planning, risk management, and various other purposes. So what are full-cycle costs? Basically, they are all of the costs in US dollars per barrel associated with finding the oil, producing it, and getting it to market. Incorrys thoroughly analyzed all of the major oil basins in the US and Canada, excluding Alberta oil sands, to determine the full cycle cost of each of these basins. To begin, exactly what costs are included in the full cycle cost? Incorrys costs are broken down into 6 main categories. Number 1, finding and development, or F&D, and these are the exploration costs related to the discovery of oil and account for about 32% of the total. Number 2, the cost of capital. How much it costs the oil company to borrow capital to finance its operations and investments. It accounts for about 22%. Number 3 is the operating cost, which is simply the ongoing expenses incurred to produce the oil. It accounts for about 15%. Number 4, royalties and production taxes. These are monies paid to mineral rights owners and taxes for various levels of government. It accounts for about 19% of the total. Number 5, general and administrative, G&A, or overhead, expenses necessary for doing business, like head office expenses. It's about 2% of the total. And finally, number 6, the basis differential. This is simply the difference between the price at the point of sale, the producing basin, and the West Texas Intermediate, or WTI benchmark price, or market price. It's located at Cushing, Oklahoma, and this makes up the final 10%. Incorrys' analysis of the major U.S. and Canadian oil basins shows North American full-cycle costs range from a low of under $50 a barrel for Permian Delaware, that's located in West Texas and southeast New Mexico, and a high of just over $100 per barrel for Alberta East Heavy Oil, located east of Edmonton on the Alberta-Saskatchewan border. For comparison, we have also included California full-cycle costs, which exceed $160 US per barrel. Some of the other key findings include the next 6 basins, 2 in the US and 4 in Canada, all have full-cycle costs below $60 US per barrel. Canadian plays, being the furthest away from the WTI price point, have the widest basis differential to WTI at over $13 US per barrel. This puts Canadian oil basins at a significant disadvantage compared to US basins. On the other hand, Canada has the lowest royalties and taxes at just over $10 per barrel. Permian Central and Midland have the highest taxes at almost $22 per barrel. And Canadian plays have the highest F&D, which contributes to overall higher full-cycle costs compared to US basins. While well costs for Canadian plays are compatible with wells with similar depths in the US, Canadian wells have lower initial productivity and EUR, which is the estimated ultimate recovery. In closing, based on the recent West Texas Intermediate price of about $70 per barrel, Incorrys' analysis indicates that North America has upwards of 140 billion barrels of oil and condensate potential.